Hello and welcome to a CMS Forex daily video recap. I'm your fundamental market analyst Nick Nassad. Today is Thursday, July 15, 2010. In today's session, we saw the dollar extending its losses against the euro, yen, and pound as data continued to show a U.S. economy that will need the support of low interest rates from its central bank. But first, let's start off with one positive release from the US, which was the weekly jobless claims for the week ending July 10th, where we saw the number of people filing jobless claims falling by 29,000 to their lowest since August of 2008 at 429,000. The better than expected figure may have been due to some auto manufacturers keeping their plants open for the summer months. That tweaked the seasonal adjustment factor, as usually these plant closings tend to raise the number of claims around this time. As we'll see, that labor market report contrasted with some weaker manufacturing readings. First up, the Empire Manufacturing Index for the month of July, which slid to 5.1 from 19.6 in June. That was the lowest reading in 7 months. While we still remain above the zero level for the 12th straight month, as we can see from this chart, it does confirm that we are seeing a bit of a slowdown in the manufacturing, something we had seen in the ISM manufacturing data from the month of June. Taking a look at the Philly Fed manufacturing report, it also declined, falling to 5.1 from June's 8.0 and lower than forecasts. Here, new orders turned negative and the shipment subgauge eased rather sharply. As you can see from the chart to the right, following a bit of a V-shaped move in the index, following the recession, we are now starting to head back downward. Both the Philly Fed and the Empire Manufacturing Index are leading indicators, and they show that the manufacturing sector is coming back down to earth following the increases in activity as a result of the inventory restocking process. Taking a look at industrial production data for the month of June, we did see output rising 0.1%, slightly better than forecasts of an unchanged reading, but much lower than the 1.3% increase we saw in May. Also, the capacity utilization rate, or the number of factories that are in operation, stayed at 74.1%. As I mentioned, the factory sector has been in front of other parts of the recovering economy, such as housing. And if we look at year over year, industrial production is still up 8.2%. So here too, we're still in the midst of a V-shaped recovery, but we'll see if this tops off in the coming months. In a look at inflation pressures, the producer price index fell 0.5% for the month of June, though the core PPI rate did rise, albeit at a tepid 0.1%. The cost of food decreased 2.2% in June, the biggest drop since April 2002, while energy prices fell 0.5%, so that contributed to the change in the headline rate. But looking at the core annual inflation rate, we see that it still remains very weak at 1.1%, and only furthers the case that the Fed will keep interest rates at their record low rates longer. With lower inflation and lower expected U.S. interest rates, that makes the dollar less attractive, as yields on treasuries should continue to fall. The expectation that rates will remain at their low levels for longer also means that the dollar will be used as a funding currency in carry trade. With the fundamentals pressuring the greenback, the USD JPY fell below its recent support at the 0.88 level and moved below the 200 period moving average that had acted as support in Tuesday's and then in yesterday's session, but today acted as resistance. Now we come close to the 87 level, which acted as very strong support both on July 1st and July 7th, so we'll anticipate that acting as an important support. Looking at the euro-dollar pair, we saw the euro extend its gains from Tuesday's session following a bit of sideways trading and consolidation in yesterday's session. Europe's sovereign debt situation seems to be easing, and the euro benefited today from a successful auction of Spanish debt, pushing the euro-dollar pair to a new 2-month high at the 1.29 area. A number of potentially disastrous political and fiscal issues have failed to materialize in the Eurozone. Despite debt rating downgrades, Greece and Portugal have held successful debt auctions, and the ECB rolled over a massive 1-year funding program into shorter maturities without much fuss. That came here on July 1st, and we saw a very strong surge in the euro following that, and we moved above a pretty important level of resistance and stayed above it since then. We also have the potential for the stress tests of European banks due out on July 23rd to further ease investor anxiety about the euro. Looking at the pound-dollar pair, we had a similar situation where the pound rallied strongly against the greenback, touching the 1.5425 area in the New York afternoon session. Yesterday, we had moved above the 1.5330 level, which had acted as resistance throughout last week, but we moved above that and then retested it as support early on in today's session, and following which we had the strong rally. Now, stocks were down in Europe and in the US, so this move does not come as a bout of risk appetite, but instead is primarily focused on the weaker US fundamentals, which is pressuring the US dollar. However, a weaker US economy is not good news for all of the greenback's rivals. A slide in US equities, as I mentioned, hurt risk appetite in the North American session, and for currencies tied to the US economy and to global growth in general, such as the Canadian dollar, had a hard time today. In the USD CAD pair, as you can see, we tested the level around 1.0280 as our support, which held, and then we rallied in favor of the greenback in the New York morning, testing 1.0440, the 200 period moving average in a 1 hour time frame, which acted as resistance, but that was also the resistance, close to the resistance that we had on in Friday's session. So we'll see if this pair trades within this range set up over the last 5-6 sessions. With data out of China coming in softer than expected overnight, the Australian dollar also traded sideways against the greenback. So where the euro, pound, and yen gained on the greenback, the currencies tied to global growth did have a hard time advancing. With that being said, let's take a look at the fundamental docket to round out the week. Tonight, New Zealand posts a measure of its consumer prices, which is followed by the Tertiary Industry Activity Index from Japan. Overnight, Japan then posts its Bank of Japan monthly report, and the Eurozone releases its trade balance. In the North American session, the U.S. posts its consumer prices, a measure of long-term purchases of treasuries, as well as the UMich Consumer Sentiment Report. Canada, meanwhile, releases its leading index. And that does it for today's broadcast. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you good trading.